Okay, thanks very much and welcome to our quarterly update, PPA kind of national market update. So thanks everyone for joining. So today we'll kind of start off with first of all, our portal. So for those of you who have joined, we've had 50% of our client base join our performance property portal. For those of you that haven't signed up, it would be great for you to obviously just jump online to portal support at performanceproperty.com.au. We'll get you onto the portal. At this stage, client feedback has been excellent. Paul Brick and the team have done an excellent job in terms of getting this all set up. There will be some new tech. We'll be running a lot of the portfolio reviews and annual catch-ups with this, obviously, property portfolio and dashboard. So it's really important that you get all of your information on there. And we'll be coming through with some new tech as of next month. So really exciting. It's really growing. So if we can get that other 50% of that client base on, that would be brilliant. You'll also have access to all of our online research reports, and the next stage is putting some live commercial opportunities on the platform as well, and that'll provide a really good update in terms of where things are going as well. So if you've got any questions, let's just leave questions until the very end of the presentation, and we hope you enjoy the following information we're going to take you through. In terms of the portfolio modelling as well, we're obviously looking at the consolidated portfolio statistics for you as well. We'll be looking at your financial reporting and consolidated tax reporting. So it'll be really, really handy in terms of some of those future features that we're going to start implementing on. So your accountant, your financial planner, it'll just be a really good way of just consolidating all of your property related information. So we're definitely growing. It's exciting. So any questions, just feel free to reach out to one of your advisors and we're happy to help. So if you do want any advice after the meeting, just reach out to one of the senior advisors here at PPA. We're happy to sit down and talk about your individual position. And more than happy to help where we can. So I said a lot of our clients we're seeing a lot of them in that debt reduction strategy. They're paying off a lot of debt on their family homes. We're seeing a lot of that activity here in Melbourne and Sydney with our clients. We have seen over the last 3 to 6 months evidence of some of our clients looking to upgrade their homes. And I think the opportunity here in Melbourne does represent an opportunity right now, for clients that are looking to upgrade their home. We're seeing a lot of people paying off the principal off their home and starting to build a really long-term portfolio. So moving into this kind of phase of the strategies is quite evident with our client base that we're seeing now. In terms of, we're very, very active in the commercial space and have been over the last kind of 9 to 12 months. A lot of our clients that own residential assets in their portfolio need a little bit more income on their portfolio. So we're seeing a lot of activity in that space and blending out the overall portfolio structure. So we have been very active in the commercial sectors nationally for our clients, and we are seeing a lot of value in that, probably anywhere between that 2 mil to 6 mil space, where predominantly a lot of our clients are playing around in that particular price point. In terms of where we're seeing the kind of national markets from a residential standpoint, we've probably got Brisbane in that whole recommendation. We've seen really, really strong rental growth occur across a lot of the capital cities over the last 12 months. I think this is going to be the year of strong rental growth across the capital cities. I think Melbourne, the exciting thing about Melbourne, it's now moving out of that stagnation phase. So for the first time since 2018, we're actually starting to see that the Melbourne market is starting to show value. And we haven't invested in Melbourne for a long time for our client base. We've been quite active in Adelaide, quite active in Perth, Brisbane. From a kind of entry point, we probably are buying a lot of assets in Townsville in that sub 700K price point in the housing sector. What we are seeing is pretty significant opportunities in the kind of townhouse sector, the villa unit sector in Perth as well. because Perth housing has gone on such a significant run. It's the entry-level affordable stock in Perth that we're seeing really starting to get dragged up. So we're actually going to concentrate on a significant buying strategy for the kind of sub 1 mil, 600 to $1 million assets in Perth, in those blue chip suburbs, in the townhouse and villa unit type dominated suburbs within 10, 15 kilometres of the CBD. So they are starting to show value. The Melbourne unit market is starting to show value as well. Sydney's a little bit further along in terms of the cycle for units. And you can see that Adelaide, where, the next 12 months in terms of owner-occupier activity will be quite strong. So I've still got a hold recommendation now, but we are being strategic in Adelaide over the next, say, 6 to 12 months with our clients. Perth, we still think there's going to be a fairly significant run over the next 12 months, but if we're able to summarise where we see the residential markets, I think the next 12 months you're going to start to see pretty significant rental growth in all of the capital cities nationally. So this is our performance window where, we're probably forward-looking in terms of the runway, in terms of where we're seeing growth. Where you probably want to stay away from in terms of the cycle is in that low demand, short runway kind of matrix here. So these are probably assets that you'd probably want to hold or consider selling if the demand increases. Where you really want to be in this particular section here is in that high demand, long runway section, where you're in that hold assets, that buy momentum stage, where you probably should see some pretty significant growth occur over the next kind of 3 to 5 years in that particular space. So, getting to that point, Saskia within our research team has done an excellent job in terms of the demand versus runway for houses. And you can see on this demand score, in terms of possible rental growth, and obviously the demand score that we probably want to see in this particular area here, areas like Gladstone, Darwin, Cairns, Mackay, Townsville, even Greater Perth, still very, very positive. Ballarat, we've still got a hold recommendation there. We need to see rents increase. Bendigo's a little bit further along in terms of the cycle, but look, the most promising thing at the moment is we're starting to see Melbourne move out of that, that demand score and moving a little bit further up. So from our end, we probably will see very, very strong rental growth in Melbourne occur over the next 12 to 24 months. I think the RBA are going to stagnate kind of interest rate movements a lot slower than they previously have from years ago. So don't expect any significant kind of interest rate decreases occurring aggressively. I think they will start to move it out over the next 12 to 24 months. But from our end, Greater Perth, Gladstone, Cairns, Mackay's looking very good, and Townsville looking very good on the cycle at the moment. For units, it's very, very different. You can see that, again, of the most positive here, you can see Darwin, Gladstone, Townsville, Mackay are all here for houses. And if you look at units, Townsville, Gladstone, Rockhampton, Bunbury, Mackay, Cairns, all of these areas in terms of growth. And probably the most exciting thing is we start to see house price growth occur at a very aggressive rate in Perth. It's that lower end affordable stock that will get dragged up, and that's probably why we're taking a position on, the apartment sector, the townhouse sector, the villa unit sector in Perth. In that 600 to say 850 sort of price point in Perth, it probably represents a really good opportunity to start buying that particular sort of asset type now. National, you can see that, of all the capital cities nationally, you can see that Adelaide's probably been the star performer for our client base, and a lot of our client portfolios over in Adelaide have done quite well. So some of our clients that maybe are in some of that debt reduction type strategy, not just yet. We still think there still should be fairly strong price growth in the owner-occupier sector in Adelaide, in the housing sector on the ground. But I think the next, say, 12, 24 months, that might represent an opportunity there to perhaps liquidate it, but we just don't think the timing's right just yet. If you look at Canberra, we're really not touching anything in Canberra at the moment. Brisbane's really ticking along. We probably expect some further rental growth on the ground for Brisbane. But you can see the star performer over the last 12 months has definitely been Perth in our view. So of all the opportunities currently of the capital cities, you can see that Melbourne has probably been the poorest performer of the lot. And that's probably where we see the greatest opportunity right now over the next 12 to 24 months. So for the first time in a long time, we're probably going to put a buy recommendation on Melbourne. We're looking at assets between $800 and $2 million in the housing sector here. This is more in the residential space. Commercial is probably a different argument, but from our end, we probably see right now, from a buying point of view, the Melbourne market representing the best opportunity currently of all the capital cities. This is the vacancy rate. So as I said before, this is going to be the year of strong rental growth. You've got fairly significant amounts of overseas migration, people moving into Melbourne, Sydney, Brisbane, Perth. We're still seeing very, very strong interstate migration into Perth. So we're not seeing any of that activity slow down. So we still expect rents to increase quite aggressively over the next 12 months. And you can see that, areas like Darwin, Perth, you've got vacancy rates sub 1% within these particular sectors. So strong rental growth expected. So if you've got existing assets within your portfolio in these particular capital cities, we still should expect strong rental growth over the next 6 to 12 months. Dwelling approvals, we're still, we've got a $1.2 million housing target that we need to meet, and we're nowhere near meeting that figure. In Sydney, they've kind of relaxed they've introduced, obviously, your medium density ratios for buildings in that, across 170 suburbs in Sydney, where they want to introduce 112,000 kind of new apartments or medium density type developments across Sydney. That'll be very interesting to see whether or not they can get that amount of medium density assets within those suburbs. But you can see we're short on accommodation of 174,000 dwellings. That's still quite a bit. So from our last quarterly research update, we've actually seen an increase in the amount of kind of dwelling approvals, and we're still short 63,000 units nationally as well. So it's actually getting worse. I thought it would improve over the last kind of 6 to 12 months, but cost of construction is still quite expensive. Developers can't get their feasibilities to stack up. So what's that going to do? It's going to push units in terms of that replacement value, and there's going to be increases in the unit sector. What it's going to cost you to build a 2-bedroom unit here in Melbourne or Sydney generally will cost $800,000 or $850,000 to build that unit, and you can still pick up older style units in Melbourne for that $500,000 to $600,000. So I think there's a bit of a play or an opportunity cost there within that particular sector. So good quality blocks of units here in Melbourne are probably starting to show value in our view. Population movement, I touched on this before, but we've got a significant amount of net overseas migration numbers. That's not slowing down. Unemployment rate is very attractive. Natural increase, we're probably seeing that that hasn't increased from our end, but look, it's more being replaced by a lot of the overseas migrants coming in. And obviously due to the taxing system here in Melbourne, you've got investors exiting the market currently, and there's not enough rental accommodation to supply that incoming kind of overseas migration coming into the country. So, we still see significant rental increases occurring. Perth, as you know, we've been very active in Perth the last 5 years. We probably still see fairly significant growth in the Perth residential markets, housing market and townhouse market. But from our end, it's the lower end, it's the affordable type of asset type in Perth that we still see there may be pretty significant growth in that particular sector, in that kind of $600K to $1 million price point. Affordability index is running at 44%. So when Perth gets to around that 55%, we start to see prices starting to ease. So you can still see there's still some significant uplift in Perth over the next 12 to 24 months in our view. Price to income ratios now, we've seen a little bit of an uptick. So a couple of years ago, it was running at 5.6 times income. It's up at 7.1 times. But you can see that the lower end of the market is quite affordable. That's still running at 4.9 times income. So it's still relatively cheap to go and buy a townhouse or a villa in Perth and rent right now. Median house price, we've seen a little bit of an uptick there. It's been, Perth's been a great performer for our client base over the last 3 to 5 years. We're starting to see a little bit of a run in terms of unit prices and apartment prices going a little bit of a run as well, but there's a little bit of catching up to do in the lower end of the market, in our view. That will occur over the next 12 months. House versus units, there's a nice little disparity there, but from our end, again, we still see unit price growth occurring at a fairly aggressive rate over the next 12 months, so that's a good sign. Household lending, there's been a little bit of a shortfall in terms of investment lending, but nothing to be concerned about. There's been a lot more activity in owner-occupier lending. So people in Perth are on the ground, they're going out and buying their entry-level first homes, they're upgrading their homes. So there's been a bit of an uptick in terms of lending to owner-occupiers on the ground, which is a very good sign. Stock on market, you can see that right now there's only 15,000 dwellings on the market for sale, and days on market is less than 10 days. So it's really quite concerning that as soon as you list a property in Perth, it's selling within kind of 9 to 10 days. So there clearly is enough stock to cater for that demand. So in our view, we still see prices rising. Vacancy rate, I haven't seen it this low in terms of, tracking all the vacancy rates for nearly kind of 30 years. You can see that the vacancy rate in Perth is probably at the lowest point that we've seen it in terms of on record. It's running at 0.4%. For an average house in Perth, it's going to cost you $835 a week just to rent out that house. And you can see there's been rental growth in the unit sector as well. So that's a really positive sign at the moment. When we start to see the vacancy rate starting to increase, rents might slow down, but the last 3 years, rents have gone from $630 to $835, and we probably see them hovering around that $880 or $900 before the end of the year. Perth job vacancies, there's been a little bit of an uptick there. Obviously, there's been some fluctuations and some volatility in the share market over the last few days that you're probably all aware of. So we'll just watch this space quite closely. But the unemployment rate is still extremely low in Perth at the moment. Sydney, we're not really taking a position on Sydney. We're not advising our clients to buy anything in Sydney right now. The affordability index is running at 86% of a person's income going to service home loan debts. It's still fairly high in our opinion. So we probably see kind of house prices softening over the next 12 to 24 months. And you look at the price to income ratio, versus Melbourne versus, Perth, it's still running at 13.9 times. But funny enough, the kind of price to income ratio for units probably shows more value in our opinion. There's a big disparity between the prices of houses and units right now. So again, over the next few years, we probably see that the unit market will start to show some value in Sydney. But from our end, if you're spending $1 million, there's probably better value in other markets to consider right now. Sydney versus, house versus units, there's a nice disparity there. So again, it's not something that we're tracking or we're taking a position on too aggressively because we just feel there's better value in other markets currently. Household lending, you can see that there's been a little bit of uptick in owner-occupier lending, and investor lending is probably coming off slightly. So we'll just kind of watch that space over the next 12 to 24 months. You can see that, cost of living is really starting to bite. Their stock on market is starting to increase. So it's gone from 27,000 dwellings, on the market last year to 33,000. So people's ability to go and afford the more, run the mortgage, cost of living, inflation increasing is all really starting to bite. And days on market is actually starting to increase as well. So that tells us that prices may soften over the next 12 to 24 months. Rents, rents, it's probably the most expensive market to rent a house. For an average house in Sydney, it's going to cost you $1,050 a week just to rent that property out. You can see rent increases in the unit sector as well. They've gone from $585, 3-4 years ago to $704. So there's been really big jumps there. You've probably got people selling up and choosing to rent, or we're seeing a lot of people migrate from Sydney all the way to Brisbane and the Sunshine Coast. So we're still seeing a little bit of that activity occurring. But Sydney's very much a global city in our view, but the vacancy rate's very low. It's 1.4%. Job vacancies are good. So there's plenty of jobs, both in the private and public sector in Sydney, which as well. So there's large infrastructure projects flowing through. So if you've got a good job in Sydney, I think you've got the ability to pay the rent. It's just your ability to service debt, which has probably been a bit of a concern for our clients with the affordability index that high. Now, Melbourne, you can see Melbourne's fairly good, because I think in terms, if we look at all the way back, we're probably getting back to kind of 2016, 17, 18 levels in terms of the cycle. So from our end, it's probably showing the best value that we've seen since kind of 2018, 19, in terms of the affordability index still has probably another 5 to 6% to come off, but it's actually starting to trend downwards. It's gone from 57% a few years ago to 53, and we probably should be tracking at around about that kind of 48, 49% over the next kind of 6 to 12 months. So it's starting to show value and it's moving out of that stagnation phase for the first time in a long time. You can see, look at the price to income ratio. It's actually better value to buy a house in Melbourne than it is a Sydney unit. So from a like-for-like basis, we probably feel that the Melbourne market is far better value for a good quality long-term investment foundation asset sitting in your portfolio than it is a Sydney unit. So, for the first time, Andre and our buying team are doing a really good job and buying really good quality residential city fringe assets, within, a 15-kilometre radius of the Melbourne CBD for kind of in that kind of $1.2 to $1.6 million price point. You take the hit on the initial net yield now, but once we see that rental growth, the yield will start to improve. So from our end, we probably see that both the units and the housing sector are really good value in Melbourne for the first time in a while. There's not too much of a difference in terms of the prices of units and houses, but there is a replacement value discussion there in terms of what it costs you to build a unit now in today's value. So I think there's going to be some uplift in both the unit sector and the housing sector, which is pretty exciting for clients that have been wanting to get into Melbourne for the last 10 years, but we've advised against it. The market is actually starting to show value. Household lending, you can see that there's been a little bit of an uptick in people going out and buying their homes, which is good. So, there's still a deterrence from people buying unrenovated homes. They don't want to spend money renovating homes, but we're starting to see some really good buyer depth. Stock is starting to trade for renovated owner-occupied dwellings and good quality investments, city fringe, in good quality areas are renting out really well. So Amy and the team have been doing a fantastic job renting those particular properties out, and we're starting to see some rental growth already starting to kick in as well. Stock on market, you can see that, I think over the next 12 months, there's plenty of available stock on the market, but all the unrenovated stock is probably, there's been some price reductions obviously being evident within the markets, but there's 39,000 dwellings, just under 40,000 dwellings on the market for sale. So our ability to buy those particular assets, there's probably a little bit more opportunity to consider. Whereas when the market starts to heat up and we start to see some further interest rate cuts, it's going to be a lot harder for us to buy. So I think the next 12 months represents an opportunity in Melbourne for our client base, and days on market is starting to creep up at the moment. You can see back in 2012, we're probably getting back to those very similar levels where days on market is going to start to creep up above 40 days. Stock on market is going to hit that 41, 42,000 dwellings. And I think that's probably the in terms of timing, it's probably the time that you probably should be taking a position on the Melbourne market. Rents, we're starting to see rents increasing as well. So that they've gone from 602 for a house up to 760. And you can see rents starting to move up in the unit sector as well. So that's pretty exciting for both houses and units on the ground, and far cheaper to rent a unit or a kind of house in Melbourne than it is in Sydney. Job vacancies, we've seen a little bit of a shortfall in terms of job vacancies in probably the private sector. So a lot of corporates are starting to, contract-based roles now being evident, starting to flow through. Nothing to be concerned about, but the unemployment rate in Melbourne is still very, very low. Brisbane, you can see that Brisbane's, from our end, last year probably stagnated in the early stages, and then towards the end of last year, it really started to go on a little bit of a run again. So the affordability index at the moment is running at 56%. So it is starting to get towards the upper end in terms of the affordability index, in terms of the long-term metrics. We still saw fairly significant growth of 10 to 15% with a lot of our client portfolios on the ground. So, our Brisbane rental team are doing a fantastic job now that we've kind of restarted the kind of property management rent roll up there, and they're really starting to push rents up. And you can see that, the price to income ratio is higher in Brisbane than it is in Melbourne. So on a like-for-like basis, again, you can see that the Melbourne market is starting to show better value than the Brisbane market for the first time in a long time. And even the unit sector in Brisbane, we're starting to see, those clients that held those units in Brisbane, we're starting to see some price growth starting to kick in there as well. From our end, the other metric there that we're looking at, there's owner-occupier lending occurring, investor lending starting to slow down. Stock on market, again, you're less than 20 days in Brisbane. So if you list a property, it's selling quite well, but there simply isn't enough stock to cater for the demand occurring. So I still think the market will stay quite strong over the next 12 months, but it is getting towards the upper end of the cycle, in our view. Vacancy rate, you can see, look, rents have been fantastic. They've jumped from 602, from 3 years ago, all the way to 747. And even, the big jump for us, 4 years ago, units were renting for 375. There was an oversupply of units. The ability to build those units at a fairly aggressive rate has been limited, because obviously developers haven't been able to get their feasibilities to stack up. So again, it's at 0.8%, very, very low in our view. And you've seen rents go from 375 all the way up to 589. So still very, very strong on the ground. Job vacancies, you can see that, the state government, Brisbane state government are very aggressively going on a very aggressive infrastructure rollout program. So there's a lot of healthcare infrastructure rollout. There's over 20 hospitals being built across the state due to the healthcare system lacking. So there's a lot of infrastructure flowing in, so a lot of government-based type work still coming through. That's still going to stay that way. You've got the Olympics still coming through. So Brisbane over the next, say, 4 to 6 years, will still stay fairly, very strong all the way up until the Olympics. So still quite a strong market and it's performing really well. Commercial update, as you know, we're very active in the commercial space. So from our end, we're starting to see a lot more opportunity than we did from 12 months ago. So Alex, Gus, Tim, Jai, the whole entire commercial team are doing a fantastic job in terms of locating assets. We're pretty agnostic when it comes to looking at a commercial asset. I think the office sector here in Melbourne is really struggling at the moment. It's distressed. You can see that vacancy rates are actually quite high in Melbourne. The industrial sectors are performing quite well, and there's an opportunity to increase those rents. So Alex and the team have been buying a lot of assets in that kind of 5 to 7 mil space for our privates in the industrial sector in Brisbane. So we are seeing a lot of opportunity nationally across each of the markets, but we're very, very active in that, say, $2 to $10 million price range, and buying really good quality commercial properties on yields of 5.5% to 6.5%, 7%, depending on where it is and what it is. So there's a lot of those particular assets now starting to present. A lot of our doctors, we've been buying, their medical sites, their principal place of business, mapping them out, finding, looking at the demographics, finding where they should or shouldn't be investing in. A lot of our clients are maybe selling down some of their existing portfolio and converting that into a commercial asset as well, because they want that higher income as they're nearing towards retirement. And Alex and Gus and the team have been doing a fantastic job in terms of looking at value add, rental reversion type assets where we're increasing the rent on those industrial sites. And I actually think it's a brilliant time to be looking at long-term development sites that you can sit on. And obviously with the new Sydney housing policy that's just come through with those 112,000 new homes across those 170 suburbs, it's going to be very, very interesting in terms of what's going to happen to that Sydney landscape within those inner city suburbs of Sydney. And the real opportunity there for the higher risk type plays is the distressed office sector here in Melbourne for our larger investors in that 10 to 50 mil space. If you can take on some tenancy risk for the next 4 to 6 years, they are starting to show some pretty significant value for the first time in 15 to 20 years. This just gives you an example of some of the assets. This is an asset that we purchased for an SMSF type buyer. This was in Prahran, long-term hold. They're going to retain and hold the asset for 15 years. So very entry level, but great location, great rental, and, pretty much a set and forget there with very little kind of maintenance or, larger cosmetic expenditure required on that asset. This was a nice little double front property in Brunswick that we purchased for sub 1.5, 3 bedrooms, obviously very well located next to the university and hospitals there, just right on the edge of Parkville. So great asset. We'll start to see some pretty significant rental growth kick into this sort of asset over the next 2 to 3 years as well. This is a commercial asset. So again, this is a sort of asset there that, it's quite a large building area. It's quite a large land area as well. Sub 4 mil in terms of price point, but really good quality tenant. They're staying in there on a long-term lease and very well located. So they are out there. It just takes us time to kind of locate those particular type of assets. And this is another principal place of business purchase for a manufacturing type client. They'd been looking for 2 years and were able to secure that. Alex and the team secure that within 3 months. So I'll finish up there. So if anyone's got any questions, feel free to reach out and, happy to answer them. Now, if you don't have any questions, we might finish it up there. Thanks very much for joining, and we look forward to the next kind of quarterly research update in 3 months. Thank you.